All right, team. So I want to show you a trade that I took. I got stopped out, how I thought about it, what I looked at, and what I could have done to probably stay in the trade longer. Because I'm looking at it right now on SPY, and instead of getting stopped out at break even, I could have probably made at least 50% return on this trade already. My goodness. All right, so let me break this down. Right now, February 21, Friday, it's a red day. Okay, I want to show you something here. I'm going to show you the charts first. Okay, let me show you the chart. This is what I have, and you can see here that got I got stopped out. At first, I had 20%, and then I got stopped out. And look, it's about to hit this WEM line. I have these marked. I marked these pre-marked before the week starts, and I'll show you how I got these. And I'm using Gextron to help me figure out all this stuff. Okay, so here is SPY, and today was clearly a red day. And when I'm like looking at SPY, I'm like, okay, how do I take a trade on SPY, right? The first thing I do is I go to Gextron and I look for my levels. I say, okay, where it tells me right here, okay, max reward is 620, max pain is 595 at the moment. That's very far, so we're probably gonna see more downside to SPY. I'm looking at the total net gamma exposure, which is really, really bad. Remember, negative 3 billion. If it's negative 3 billion, it's directionally biased to the downside. If it's 3 billion and above, it's directionally biased to the upside. And as of right now, the spot price, this was taken around 603. Okay, so, or 606. And clearly here are, okay, so these are the levels, right? And when I took the trade, I said, okay, where's max pain? I marked those levels. You see here, I'll have max reward, max pain, and then I got to find N trans and P trans level. So that's like negative transition and then positive transition. Okay, so right here I marked it at 605 for N trans, and then I marked it here for 608 for P trans. Okay, so the data changed a little bit now. Okay, so it probably got updated here. So 605. Wow, that's crazy. So let's update that. At first, it was 609. That was the original one. So right now, it's changing. Actually, I'll just leave it as it is. So when I first looked at this data, this is what it was. Okay, and then but before doing any of this, I'm like, I need some realistic boundaries. Like, where can this possibly go to for the week, right? And so you see these lines right here called WEM. Okay, so and this is just for me to be like, okay, this is weekly expected move. Okay, so before the week starts, I go to Gextron and I say, what's the weekly expected move for SPY? And so right here, if I go to the little calendar area, you'll see here that you'll see all the expirations available for that given ticker. And in parentheses, I have these like plus and minus numbers. That's the weekly expected move as of right now. And the reason this is really important is because it's taking into consideration um, implied volatility. It's already baked into the option premium. So we're going to use that like a straddle method and a strangle method to get the expected move. And then I add it from the current spot price that we're at. So by like Sunday evening or whatever, when I'm looking at the charts, I'll say, okay, what's the current spot price? What's the expected move for the next week for like Friday? Oh, it's $9. That's a big move, right? Okay, let me mark that up, right? So that's what I did for the week prior. And you can see here that we got close to the weekly expected move to the top, and now we are literally right here at the weekly bottom, right? The WEM line at the bottom. Okay, so with that being said, now that I have this range, I know what to play with. I know what I can expect within the week. Now, it doesn't mean that it can't go lower or it can go higher. It can always do that, especially on really volatile days. It's very, very possible. Okay. But this is about a 68% chance that price will be somewhere around these ranges. Okay. All right. So the next thing is, again, I mark up my areas of interest, my max reward, my P trans, my N trans level. And then how do I get a directional bias? Well, it's all these things together, right? It's like, okay, today we have a negative 7 billion net gamma exposure. That's what Gextron is telling me. And we are below entrance level, at least from the time when I recorded this, or when I marked this level. Now I just need to see if there's volume, right? We can see volume. Perfect. Let's take it for a short. Okay, I took the short around this time, and then I got stopped out. If I would have caught it here, that would have been a different story, but I didn't. I caught it. I tried to catch it right here. I got it pulled back, got stopped out at break even, and now it's going down further, right? So I just missed on a good opportunity right here. Wow, it's like about $100 per contract by now. Okay, so there's that, right? And it could go lower. You can see it's tapping into this area. Okay, what's next? Like now it's like, how do I pick the right contract? Well, before I got into a trade, I was like, what contract do I pick? And of course, I picked yesterday or Monday's expiration. I go to my gamma decay here, okay, and I say, okay, show me all the puts. Perfect. You see this red? Okay, these are color coded. Blue means very low negative gamma. Blue is better for like hedging, okay, if you need to hedge. Red is really high gamma levels, very sensitive. That means delta is going to be very, very sensitive to these movements, right? So red means very high gamma level. There's still a lot. Green is pretty low. There's yellow somewhere here too, but those are kind of like stable, mid-level type of gamma. Those are good for like swing trading, maybe 1 to 4 weeks out. Okay, so I picked the 603 contract because it had like a slight red there. You see it right here. It's slightly red. And so I said, okay, I'll pick two Mondays. This doesn't even show me Mondays right now. Okay. And so all you want to do is like, for example, like I picked, since it was such a like short-term expiration, like literally a 2 days, 3 days out, I wanted to pick something with high gamma. Now there's some cons to this, okay? Because when gamma level is here at red, when it's showing me red, that means it's like really unstable delta. So it can go crazy. Okay, it doesn't mean it's risky. Okay, if I wanted to do something better, I would pick something around the yellow or something low stable like a 595 6 put or something like that. But you got theta decay, right? So you got to watch out for that kind of stuff. But you want to pick something that's not super warm on the gamma decay chart here. Okay, so this is how I'm using this table right here to show me like what contracts to pick. Okay, and that's pretty much it. Now, what I could have done better for this trade is that I could have gotten probably like 4 weeks out. That would have definitely I would have definitely been able to hold onto my position a lot longer without being like shaken out. Once your contract hits like 20% return, like you want to start looking into having a break even stop loss, especially short-term expiration. Theta is going to kick in faster, right? You don't want to like risk it from turning a green trade into a red trade. So that's why you got to start setting those break even stop losses or trailing stop losses. All right. So that's how I did it with Gextron. This is all I did. It was just that simple. What I should have done better again is just pick something further out and then just says we know this. We're playing the weekly expect the move. I could just be doing this like 3-4 weeks out. That way I have time. I have some cushion for any like volatility pullbacks or whatever intraday movements. But that's pretty much it. That's how I was looking at this trade. All right. Peace out.